Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. It's Thursday, September 14th, 2006, and the market's just closed. I've got the Nasdaq 100 Trust up on the screen right now, the QQQQ. And yesterday I had pointed out that we've got a lot of reasons to think that this area that the market's in right now is a good place for a consolidation. I still believe that's the case. Obviously, nothing's changed in a day. But we did take out this or test this June 2nd high at $40 a share. Market closed just below it after getting as high as 40.22 and probing up through that declining 200-day moving average. I emphasize declining 200-day moving average because when we put it in the context of the bigger picture on the weekly time frame, you can see that we still don't have a real healthy uptrend in this market based on the longer term context. We do, of course, still see that this trend line is holding, which is very nice to see. But again, I'm going to point out the Fibonacci yesterday that I pointed out yesterday. It's not necessarily that I'm a big fan of Fibonacci or I think there's any magic to the numbers, but I do recognize that a lot of people look at Fibonacci and a lot of people look at moving averages. There's no magic to them by any means either. They're all just little pieces of a very complex puzzle, and what we have to do is recognize the way other people look at these pieces of the puzzle and what their actions are. As I pointed out yesterday, a lot of times you'll see that declining 200-day moving average, the market rallies up to it, and institutions start thinking, well, I'm going to stop buying aggressively here. Other hedge funds will start thinking, hey, it's up to the declining 200-day moving average. Here's a good place for me to take profits. Here's a good place for me to put shorts out. All in all, again, it's just a place where we have typically less demand and more supply. If you put the Fibonacci in there as well, and you just took the 200-day moving average off altogether, you might have other people that trade on Fibonacci kind of looking at the same type of reasoning, and that reasoning is, well, it was prior. I'm sorry that now that it's retraced 2/3 of the of this decline, I'm going to start to sell some of my profitable positions from what I bought down when the market was deeply oversold. Others might say, hey, I'm going to stop buying. And again, it's just supply and demand. We also have, obviously, this level, just at about $40.30. That was pretty significant support for the market, for the Qs, that is, for a good part of, what is this, from November of last year right up till May. So about 6 months worth of support in there, and it was resistance back in here. So there's a lot of reasons to think that we are and continue to be at an inflection point. There's no reason to think that the sellers have taken control in here yet. If we look at a 10-minute time frame, we can start to see that we haven't really seen any signs of distribution yet. These moving averages still haven't crisscrossed. I think we're going to get that tomorrow. But when we look at the semiconductors, what I look for in here is this is showing signs of distribution and more just sideways action. We can't call it distribution until it actually breaks down. We never know in hindsight what it really is. This might be just the next pause before another rally higher for the SMH. And certainly the SMH have been making these nice rallies higher after the low volume consolidation. So again, very little changed for the market in a day. It was a nice bullish low volume consolidation for the semiconductors. If you just take a look at the, again, we're looking at the relative volume. We saw volume increasing on the way up in the semiconductors. Now they're pausing here. We've got low volume. So it's a relative measurement, that is volume. So that's what we want to be focused on in here. And the spiders, SPY, again, I still think that inverted head and shoulders we've been talking about for the last couple months looks valid. It's getting close to the projected upside target that we had laid out, 2 months ago, up near 133 to 133.5, which also coincides with the highs for the S&P 500. So we'll see what happens in here. It's going to be interesting, to say the least. It always is. But that's why we have to focus on picking good stocks and finding the right opportunities on the long and short side. That's where our edge really comes from. That and a good, strong money management program that takes into consideration that your best move is really defensive, to be treating the market defensively and always looking to minimize risk. Let's go ahead and take a look at some of the stocks we've been in and mentioning recently. First up, we'll take a look at this Bebe Stores, and symbol BEBE. I had suggested buying this one on, I believe it was Monday, at $21.45, right in here. And the stock has rallied nicely. Yesterday I said it's time to raise our stops significantly up to this level here, which was just below that 22.80 level. So you should have been stopped out at about 22.78 today for a gain of about $1.35 and a nice little move in Bebe Stores. The next stock we were in was Enzon, symbol ENZN, and Enzon Pharmaceuticals. We had gotten in at $8.21 right over here. And yesterday I'd suggested raising your stop significantly in there as well, up to 8.34. So you should have been stopped out of that one with a small gain, about 13 cents. CDC Corp, China. This stock never got going above that 570 level that I thought it was really going to need to take out in order to get that upward momentum going. So the stock, I failed to, I think, mention a stop yesterday, but ordinarily I would say probably right around under there. So I'm going to say that, in fact, probably the 5-day moving average at about $5.58. So we're in yesterday at 565. Should have been stopped out for a loss of about 7 cents. I think it's still worth keeping an eye on. The daily time frame looks great. Just a nice consolidation up here. The weekly time frame still looks great as well. It's got to get above that 570 level, and then the buyers can really, I think, step in there and take control and push this thing higher. But for now, I'm out, and if you're still in it, you're going to use your own stops, obviously. AH was our only short position that was open from the last 2 days, and I didn't mention any new ones last night either. We got short AH after this rally, and then it started to decline yesterday, so that was a nice sale. Let's take a look at it on the 5-minute time frame. Right over in here, after it took out the 53.65 level, I believe it was, or 52.75, and shorted at 52.55 on the way back down. Yesterday, I suggested that you raise your stop, lower rather. This is a short position. Lower your stop to 52.35. Today's high was 52.27.28. So still in the position. The target was 51.50, and again it came down almost to the daily S2. But if you're still in the stock, I would say why don't we just put our stop right up above that 51.90 level, and that would lock you in a profit of approximately 65 cents if you're to get stopped out there. Stocks that I had mentioned last night were just 3 longs. XING, first of all. I had suggested buying XING above $11.80. You can see above $11.80 occurred right here. Our stop was then going to go below $11.60. That never occurred. So initially, kind of a fake out in here. Let's take a look at the 2-minute time frame. Looked like it was going to run. It didn't. It didn't stop us out either with this low at 60 cents. Our stop was 2 pennies below that, so it was a nicely placed stop. And we had a nice run this afternoon. Now, I still think the stock looks higher, and stop could probably go. Let's take a look at a 5-minute time frame here. And so let's just say below this little after morning high of 89 cents. So let's put our stop at 11.85. I realize that's a little bit more room than I might normally give it. That would be giving up most of our profit. But I think the stock can still head up towards that $12.50, $13 level. So I'd still like to think that this one has some room for upside. CYTR, here's this little penny stock. And again, another low volume day. We were looking to buy this stock above this high here, above 48 cents. You can see that today's high was 46 cents. So there was no purchase in CYTR. I would say continue to watch this stock, and I still think it makes for a good purchase above $1.48. And yesterday I was suggesting a stop at 138. Now I think you can actually put your stop at 141 and still have the same entry. So a little bit lower risk because the time has taken care of that by creating a higher low in here today. And you can see that 5-day moving average starting to flatten out as well. So that one acts like it might have the potential to go. Keep your eye on that one for tomorrow. TiVo, I had suggested that it was buyable in the current range, and the current range was right around that $8 level. I had suggested a stop of $7, just below 7.90, so 7.89. You can see today's low was $7.90. So no reason to be out of TiVo. I would say that I'm going to lower that stop by about 3 cents. Let's say our stop is now 7.86. Just to give it a little bit more room there. I still think the stock has the potential to go, but let's just give it a couple more pennies. Just get it below that 5-day moving average by a couple pennies. My name again is Brian Shannon. If you're seeing this anywhere else other than on my blog, do go by to alphatrendsblogspot.com, because that's where I post things that you're not always going to see at other places that pick up my videos. Thanks for your time, and I'll be back later.